Learning is the key to successful investing, and who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at Learn, Grow, Invest.
All right, so since it is now earnings season officially for Q1, I thought I'd go through some of the reports for, I think I've seen most of them that are on my watch list, not in any particular order, but I'm going to go through and see just how the companies are doing. It is the time where you just kind of want to see how my estimations have been going for the year. If I think that things are trending the way that I expect, particularly for certain industries. Are things trending up? Are my dividend stocks able to pay dividends? And if there's any stocks that's on my watch list that will remain on my watch list, or maybe I will reconsider depending on how the quarter goes. Now, I don't really remove a stock from my watch list after one quarter. I don't have that type of timeline. But if it is that couple of quarters, or maybe the end of the year and the first quarter not really shaping up so well, then I may make some other decisions there, but we'll kind of just go through it, right? So let me know which companies in the chat you'd want me to go through. I do have a list in mind, so depending on how soon I get through my list, I can go through your list as well. So just tell me in the chat which stocks you are going through the reports for and why. And please do share this in the various community groups. I didn't get to do that before we started, so I'll ask you to help me out with that. And of course, usual like the video, etc., to help us grow the channel, right? So let's start with a stock that we've spoken about a lot recently. So Dolphin Cove, I'm going to assume that this is the price that it ended at today. Let me just refresh the page to make sure. I think so, right? So it's actually been up and down, I think, Dolphin Cove, where we know about what happened at the start of the year, and that's well documented here. But you've seen like literally what feels like a bumpy ride in terms of the stock price. A lot of volatility. I think investors are trying to decide how they feel. Of course, this growth tells me at least there's some expected optimism, at least in the short term. We saw their report, and gonna go through it and talk about whether or not they can still pay a dividend, etc. Hey Jared, good to see you. I didn't know you're interested in investing, sir. Let me know if there are any companies on the Trinidad Stock Exchange that you'd want us to go through. Because I do get the reports from the TSE. I go through them sometimes as well. But for some reason, I haven't started content on the Trinidad market yet. But I've been tracking it for over a year now. So let me know if there are any companies on your radar. I can go through it for you. Yeah, so Dolphin Cove is one that we've been keeping an eye on, especially in light of recent events. So let me just look at this first one here. Their Q1 2025. Now for them, their audited results came out finally for 2024, and I'm not sure I'll have time to go through that, but let's look at the Q1 report, and I don't think anything would have changed for the top 10, so I'll leave that alone for now. So usually for earnings review, we focus on the P&L, we focus on outlook, because we just want to see how the company is trending in terms of revenues, etc., right? So for the 3 months last year versus this year, there is a decline there of 16%, and profit after tax is 0.9 or 900,000 US as opposed to 1.4. So we're seeing a 38% decline there, which I wouldn't necessarily say is surprising in this case because of what's been happening with them. I'm sure that's having an impact in terms of daily operations, performance, etc. One of the things I do like about the company that I will say here is the number of shares in issue. I've always thought that Dolphin Cove would be perfect for like a stock split because, of course, the shares aren't traded as frequently. There's not enough liquidity for this stock. That's another topic for another day. And of course, EPS has fallen because, of course, profits have fallen. So the two are correlated. No dividend declared, right? Which is one of the things we look for. But of course, it doesn't mean they won't declare one. But as at the point of the report, none. And we saw last year at this time, they would have declared one, right? So in the first quarter, their parks welcomed approximately 46,000 visitors. And what I will do, since I have that number, is look to see if for the previous year, they show that number as well. So let's look at Q1 for last year, just for the comparison of that number to see if they showed it. Because, I mean, if you're going to put the number in one, you should put the number in the other, right? And we saw where for this, no, they should be 2024. Wrong report. Is this Q1 2024? Okay, here we go. Just want to see if we can compare that number, but it doesn't look like they did it here. Just doing a quick scan through. We don't see the numbers here, so we're not sure what. So they have it here: 46,000 visitors. Oh, see, that's why I should read. Reflecting a 25% decrease compared to the same period last year, right? So that decline is telling. We haven't even gotten to hurricane season as yet. So that's not boding well for them in terms of profitability growth or revenue growth. The decline was mainly due to adverse weather conditions and the reduction in cruise arrivals related to ongoing repairs in Ocho Rios Pier, which is expected to be completed October 2025. Revenue for the period was that, we read that already. Given the performance, management is focused on reducing direct costs and operating expenses to mitigate impact. To me, to make this decision here, when you probably would have seen the trend from Q2 last year till now, to say this now, that you're gonna focus on reducing direct costs, that I don't know if that means layoffs or anything like that, but to me, they're slow to make those changes. I would have expected after burial last year and maybe Q3, Q4, they would have said that, but I guess better late than never here. And went through this already. Payroll increased due to increase in minimum wage. As a result of these factors, company generated 0.9 decrease of 38%, as we mentioned before, right? These things we won't focus on for now, but you can plainly see last year the stock price was higher at this point. Price would have gone down, and it's a lot lower now because when we looked at it, it's $12. At the point of this report, it's actually lower than it is here. It's almost down about 33-34%. So there's that. And let me see what else here. So we have revenues for the dolphin attraction and then the ancillary services. Both have declined. The dolphin one significantly, about 20%, and this one maybe about 10%. So overall revenues are down. Direct costs have pretty much remained the same. I guess this is why they say they're going to try and reduce this, because if they're able to see some reduction here, that will improve gross profit and then ultimately net profit, right? Selling expenses have already gone down here. Other operations are pretty much flat, and administrative costs have gone down by about $78,000 already, right? So they've already seen some reduction there. Profit before finance income is down 700,000, and then you have finance income, costs, taxation, etc. Right, so they're trending downwards in terms of profitability, not a good sign for them. And if you know of the other issues that are happening, then they could be experiencing some inconsistency in terms of profits for a while. And of course, everything else we'll look to see how it progresses for them. But of course, I don't know if this was leading to maybe some optimism for Q1 report. But of course, with it being out today, we'll see how it trades next week. It ended the week at $12.09. I wouldn't be surprised if we see this go below $10 just based on this report, what they've said in the report, and other factors. It's not very likely that they would announce a dividend, but let me see the dividend that they declared. Did they declare anyone? So they declared a 6-cent dividend last year. So let me just do some math here. So the 6-cent dividend last year would have been multiplied by, I'm just looking to see if it's likely that they can still declare a dividend. This is 23 million Jamaican dollars, which, I mean, is that right? 23 million? I hope I did that right. Let me know if I calculated that right. But 23 million is pretty much what they would have to pay out to pay the dividend that they paid last year. And their profit was 900,000 US. So I would say based on that, they can pay the dividend if they choose to. 23 million out of 140 million is not, it wouldn't be as a stretch. Oh, 60 cents. Thank you. Because I knew that seemed low. So it was 6 and not, thank you guys. I apologize there. Because I was like, I know that seemed low. All right, 235 million. So then certainly not the same dividend if they're doing it based on a quarter by quarter profit, but not sure how they do it here. But certainly with how things are trending, it would not be wise to pay a dividend at this point. But it's their call. We do know that, for example, they may need funds, the parent company, to take care of some of their bankruptcy proceedings. So there still may be a dividend announced, maybe not 60 cents, maybe less, because they've done 40 cents before in the past. So they could still do a 30 cent, 40 cent dividend. That would be within maybe the amount that they earned. Let me see if they did 900,000. And again, this is maybe not how they would do it, because maybe I should look at their dividend policy, right? 392 million. Yeah, that's what I was thinking, like a 30 cent dividend if they're, for example, wanting to pay out all the cash from the quarter, who knows, right? So 20 cents, 30 cents, maybe we'll see that. All right. But that's it more or less for Dolphin Cove. Let me know again what reports you'd want us to go through. I know one of them that persons have been asking about as well is One Great Studio. So we'll go through that one as well. I believe I saw this halt down today, if I'm not mistaken. Yeah, so usually when you see like double-digit percentage, very likely it might have. Let me check here. Open at 44 cents, as low as 36 cents. That looks like at least 15% down. Yeah, so it might have halted down today. And of course, we have seen, well, if you caught the stream we did last week, Friday, before the report came out, I was saying, I'd love to see how things progress for them, the report after the acquisition. And I would have estimated the admin costs, and I was actually pretty accurate. So we'll get there. I think for this one we can. They do a nice summary here, so I'll go through that in a second. But I want to go straight to the profitability, right? Because I was saying that I thought at the very least, though, revenues would have been up. So I was surprised to see revenues down. So revenues down here. So maybe it is that because I would have expected acquisition February 2025, at least February, March numbers would have been here. I mean, at the very least. So to see revenues go down after the acquisition here, I'm not sure. We'll see how Q2 is. But revenues down, cost of sales are pretty much the same. But then of course, gross profit would be lower because revenues were lower. Admin expenses, I was projecting about 29, 30. That's what we're seeing there. So operating profit would be negative because, of course, if you do 20 million gross profit and your admin expenses are 29, that's going to put you at a loss. So it's saying here acquisition costs. I don't know if this is like related costs, fees, etc. Other income, other expenses, and then they have things like, depreciation, etc. Right? And even though I'm wondering if this depreciation is mainly due to assets on the DRT side, I'm not sure because it's pretty much doubled from last year. For some reason, my face itching me. So there's that. So they made a loss before taxes. Being a junior market company, they don't pay income tax. So negative 13 million, which, well, let's go through the other stuff first, right? But EPS will be negative as well. Let's go through the summary because as I said, they pretty much do a decent job with their summaries. So we may have time to go through all of it. No, that's 4 pages. I don't think so. So it says they entered 2025 with confidence and strategic focus. First quarter reflects continued investment in team capacity, systems, and operational readiness. While top-line revenues softened due to shifts in the SEO market, other business lines showed strong growth. Notably, non-SEO revenues surpassed SEO revenues for the first time, marking a meaningful shift and expansion in our revenue model and our strategic focus on building a house of agency brands. I got a lot from this line, right? I took a lot from this line. So it says, no, I won't get into that now, but this says a lot to me. This line here, these 2 sentences, I can read a lot into this. I won't get into it right now, but it's interesting that we're here. They would have IPO'd, I think, 2023. So we're 2 years since. Yeah, I'll pause that for now. My brain is just going all over the place. Right, so the acquisition is already delivering value and expanding their services. I don't know if they would give a breakdown of revenue lines. I'd love to see, DRT revenue, SEO revenue, and then maybe core 1GS revenue. I'm not sure they would do that, but that would be helpful at least quarter over quarter to see, because if they're saying that DRT acquisition is already delivering value and then revenues would have been, where it is, that tells you the gap that has been created by the SEO business, right? And if you go back 2 years ago for maybe 2023, 2024 report, you'd have seen where we're coming from, right? Let me see if I can just do that. Quarterly financials. I'm going to be opening a lot of reports. Hopefully you're following me. Second quarter, so we don't have Q1 2023, but this one, first quarter, we should be able to see it from here. Right, so yeah, so this is what I was saying. Look at this, right? So 2 years ago, we were at 114 million, right? I think they would have been listed in 2022 then, if you're showing 2023 here. I don't remember one of those. But so if you think about it, 2 years from 114 here to about 76, that's what, 40 million in revenues decline for 2 years, and that's after, acquisition. Though the acquisition may not have been realized for the full quarter, that decrease in revenue is substantial, right? And we know they made a loss this quarter, but it would have been 21 million for this quarter. And I think for this one, did they have a lot of expenses? Admin expenses were 17 at the time. So year over year, admin expenses went up, and then we see it's at 29 now. So their admin expenses have grown in 2 years about 60-70%, and revenue has declined maybe about 30-40%, doing the math in my head, so I may be wrong. So that's what we're seeing for them. Let me see what else here. Income, we went through that already. The net loss of 13 million and operating profit of 11.2% were due to strategic investments in team growth, shared services, infrastructure, and acquisition integration. Still, with a debt-to-equity ratio of 2.55%, the company remains well capitalized and financially resilient. So I completely understand making a strategic investment and seeing a loss in the short term. That's normal, right? Companies make investments may say, a big charge or a lump sum cost in the short term, and then you recover. So really, time will tell the benefits and the values of what they're doing. Now, what they are doing at this point is increasing their admin costs based on pretty much they would have increased their team size as well, right? So really have to see how revenues pan out. Now, assuming that there were some one-off costs, well, I'll get back there, because the acquisition costs were just about 2 million. So we'll see how the quarters progress, because maybe 2 or 3 quarters in for the acquisition with DRT, we may start seeing some recovery in terms of profitability. But then we didn't necessarily get any kind of projections or targets for the DRT portfolio. So would have gotten, I think, some projections in the prospectus for the SEO business, right? Which I would have thought that based on how things have shifted, maybe some sort of communication about projection or where they're seeing the business, because I would assume that their projections for the growth of the business has changed. Their investments in additional product lines would have been because they're trying to mitigate against the decline in revenue for the SEO business, right? So that's how it would be interpreted by me anyway. So company reported total assets of 708 million, up 677 million from Q1. Total equity decreased, while liabilities increased by 47 million due largely to the earn-out portion booked for the purchase of DRT and prepared income received from clients. So maybe I need to look at their balance sheet as well. So I'll do a full review there. But doing year-to-year comparison, their cash and short-term investments would have gone down. Total assets went up. I believe DRT had a media monitoring tool that would be, of course, considered an asset at this point. Though I'm not sure what that is valued if assets here grew by, 41 million. So I'm not sure if that is the gap. I'd have to look at the balance sheet. Maybe the numbers for the year, the audited numbers, will state exactly what the differences or the addition would be. Liabilities are almost doubled, maybe 80 or 90%. Debt has gone down, which is good. Equity has decreased slightly, right? At the end of the period, cash resources total 172. The reduction in cash is due to the acquisition. We know that. The company's balance sheet shows only 15 million in debt, which is good, right? So the debt being low is good for them. And it would be better, of course, to take care of debt and keep a low debt balance, especially in a service-focused business, right? And I showed number of clients and retainers, etc. So I'm going to go straight to the All right. They reported operating loss of 9 million stemmed from several long-term investments. So it says several here. The one we know about is the DRT Communications one. So maybe there are others that we have not been informed about, or maybe it's there, but I'm not seeing it. Notably, this includes costs associated with the acquisition in February, a marketing, communications, and technology-driven media monitoring division, as well as increased spending on team expansion and brand repositioning. This led to a 41% increase in admin expenses, consistent with management's growth-oriented strategy to position 1GS as Caribbean's #1 house of agency brands. Okay. So client concentration remained low, with the top 3 clients accounting for approximately 22%. No single client contributing more than 10%, affirming a healthy diversification of clients. I think we reviewed those already. Caribbean is 56% of the business, North America, and then Asia. So I thought with the SEO business especially, there are opportunities to grow the business outside of Jamaica. I still think that's their best bet here. So I'm looking to see how these numbers increase over time, right? Because we're saying of the 76 million, more than half is coming from Jamaica. It could be because they're physically here, but of course, there's nothing, I think, with if they do have the HV SEO team in the US, and I'm assuming that if they need to travel to, finalize a deal or so, but they do say they work with agencies in the, well, I don't know if 1GS said that, but I know that's something that Juvain has mentioned that he did previously. I'm assuming that brought forward, right? So let me go straight to the outlook. All right, so growth platform, the house of agency brands, they continue to evolve as a multi-brand agency with each of our brands, One Grade Studio, High Voltage, DRT, and Snap Sites operating high potential markets. This strategic platform allows for specialization, efficiency, and scalability across client types and regions. So I'd love to see the revenue breakdown by these four. So you see, similar to when we saw the Dolphin Cove one, where it showed you dolphin attraction revenue, ancillary services revenue. I'd love to see that type of breakdown here. So in Q1, we were at that part already. So the DRT acquisition added 21 new client relationships and extended their capabilities in media monitoring and marketing communications. These clients are now fully within the 1GS ecosystem, with operational and cultural integration actively progressing. DRT's marketing, communications, and so on have been fully integrated, right? So to me, the next quarter is the best test of the value of the acquisition. I mean, I will say though, one of the things I have noticed, because we are familiar with this space a little bit in terms of marketing, because some of what we do as Learn, Grow, Invest do fall within the marketing bucket. We do content, but certainly not to the full breadth of what DRT does. And we have seen where customers are reducing marketing spend, right? So, companies are, so it could just be a matter of the season, but again, understanding the breakdown will tell us. But of course, again, 114 2 years ago to 76 kind of makes you not clear of the 4, which, so it's, yeah, again, my brain is going all over the place. So the group enters Q2 with a solid pipeline and a confident outlook. The company has strong flow of clients and new contracts, which is expected to yield strong returns in the coming quarters across digital, marketing, communications, and a newly integrated DRT. Our growth strategy remains aggressive, with structured focus on placing greater emphasis on fortifying their presence in Caribbean markets. So I don't know if the Caribbean to them provides whether higher margins or lower risk, where they believe there's untapped potential and a rising demand, deepening cross-selling and upsell opportunities across business lines. So it would be great if this is leveraged, especially since they've added 21 new clients. So I'm wondering if the 21 clients here is included in the 87 that they showed, right? But I guess we'll see as that goes forward, finalizing the integration to unlock. I mean, it says here finalizing, but it says they're fully integrated. Maybe this is like from a paperwork perspective, I'm not sure. This acquisition aligns perfectly with their host of agency brand strategy and so on, right? And then, of course, they're thanking, as usual, everyone. Yes, I'm going to go through this at another time, but the intangible assets here, I think, is this one. Yeah, so maybe about 100 million in terms of intangible assets increase. So maybe that's the value for the media monitoring tool. I don't know. I don't know if that's the gap, but again, maybe the audited numbers will have that broken down so we can see that. And of course, for 1GS, in terms of trading, they started the year at about 68 cents, down 32% from IPO. I don't remember what's their all-time high. I don't like the fact that JC doesn't show me that. How far back can I go? This is 2023. Okay, cool. Because sometimes this doesn't work as it should. So I'm happy to see that. I'm just wondering how long maybe they were above $1. I'm not sure. All right. But certainly they started the year at 68 cents and now they're almost half that, right? So 34 cents would be half. So it's almost down 50% year to date. So 42%. So maybe the market does not have confidence in terms of the acquisition because usually, acquisitions lead to at least positive in the short term. So there was, at the point I believe they announced the acquisition, they were at 49 cents. So there was some growth there, about at 20% growth, but then it's went back down maybe in a matter of 2 weeks back to where it was before, which is actually normal, right? But then I guess persons were expecting, so let's say the acquisition would have led to increase of revenue and profits and maybe would have seen an uptick here. So I guess investors are not, responding well to the report that came out today. So we'll see how it trades in the next few days. But certainly from where it started in terms of IPO, down 60% at this point. So I don't know if it's, I don't know. I'd have to do some like a full analysis of the report. I'm just looking at the quarter here, but that's how it's been. That's what the Q1 has to show us. So that's it for 1GS. I know our members have been asking for that one specifically. So hopefully this was helpful for you. So for me, for 1GS, I'm looking for true benefit of the integration. So I'd love to see so this is their Q2 last year. So let's see what they would have done. So this now would be a year. This would be a full quarter after acquisition. So let's see, there was a decline again last year. Q2 was actually, I think, more than Q1, right? So let's see, I don't think I have a feel for the quarter in terms of the seasonality of revenues. Does it show that on the JSE? So we saw in terms of numbers because again, kind of one of the things that sometimes is missing for JSE, these numbers, because these numbers are available, but they're just not here. So because we're at Q1 now. But this was for last year. So this is what they did last year in terms of revenue for Q2. So let's see if there's growth here, right? Because that would be now a quarter. Because I think last year at this point, they had already stated a shift in focus for because we would have seen SEO impact, I think, late 2023, early 2024. So it's 1 year later. So let's see how they would have, you know, adjusted, and no acquisition is completed and everything. So we'll see what Q2 looks like for them. The profitability for the quarter was 13, but of course, it being negative now, we should see how things kind of progress for them, right? So I'm going to pause there for a minute. I don't know if you all have any questions. I'm not seeing any questions. Let me know if you have any questions, or let me know which companies you want me to go through. I'll go through just one more, I think. Don't want to maybe spend too much time. So 1 second, just replying to a message here. All right. I just got some great news. Awesome stuff. There's no basketball tonight, so I'm here. All right. Wait, there is basketball tonight. I completely forgot. The Knicks playing. Let me see how. Let me just do a quick look here. The Knicks are playing the Celtics. I'm just gonna see how that's going. New York is up. Very good. I want the Celtics to lose, right? I do want the Celtics to lose. I think I don't think the Celtics are overrated, but I do think they're lazy, right? They had an opportunity to really, you know, show some dominance this year, and they missed they dropped the ball. I will say, but I'm very disappointed with Golden State. I think, I mean, you bring a guy in, he's the second highest paid of 15 players, and he can't win a game for you. That's disappointing. Now, I am a Jimmy Butler fan, but that was disappointing to see, because I was expecting to see the same Jimmy Butler that brought the Miami Heat to the finals twice, right? And in both games for Minnesota, the last two, we had chances, we had leads, or at least the game was close. Every time the game was brought close, Minnesota ran away with it, which kind of tells me Minnesota kind of lazy as well, but we'll see. But I don't know if it's lazy, but if you come into, and this is what I noticed with, for all of you who are not sports fans, I apologize. What I noticed with players, and 1GS is very, 1GS, Golden State is very fascinating to me in the sense that it's like, so Steph Curry goes down and it's like they forget how to play basketball. People can't shoot, people can't play defense. Even when Steph plays, he doesn't play the whole game. So the way they played without him being there, I would understand the first game if you're trying to adjust. But you're telling me that you don't remember how to play basketball for three whole games? That was disappointing. So I'll watch this game when I'm done. It's good to see Boston being down. Boston has the highest payroll, right? So if Boston was a stock, we'd be shorting that stock right now. Is what I'll say. All right. So we'll see. Congrats to the Knicks. I know Stephen A will be very happy. All right. So persons are asking me to look at NCB. So I say Humble Boss says Cygnus with Cygnus. Credit investments. Let's look at NCB, because I think they are worth checking out here. That's the thing. It's supposed to be a team sport, and yet, as I said, is that the players forget how to shoot once a star player is not there. It's very, and it's interesting because when I look at teams or lesser teams or younger teams or inexperienced teams, look at the Rockets. The Rockets really could have won all of those games for that they played with Golden State if they pretty much had one person with some amount of experience, because you saw what Van Vliet was able to do. So if you had one more person to support him that wasn't that had some level of playoff experience, they would have beaten Golden State. And I actually think Golden State, no, I think Rockets versus Memphis might have been a better series. Maybe that would have gone 6 or 7 games. All right, so no more sports. I apologize to those who are not interested in sports at all, right? So NCB is here. No, this just, I mean, shows you just the volatility that has been with this company. Now, I still stand by the fact that when I say volatility is good, it gives you opportunities, of course. But of course, for those who are looking for like stability, consistent growth, etc., these certainly must be, it's disconcerting for you. But let's look at their latest results here. I do remember they announced a dividend, if I'm not mistaken. I was expecting an increased dividend, right? For 6 months. Okay, I was expecting an increased dividend. Don't ask me why, but I thought that they could have done that. That was me, right? So this is 6 months, and NCB is gonna probably take us the rest of the time. So I may just maybe do another session next week or something, but let's see. Now, 6 months ended March 31st. Net profit 22 billion. Net profit attributable to shareholders 13.3. Equity, well, it's better when these are compared. We don't know if these are good or bad, right? So let's see if there's growth. EPS certainly being a positive number, and $5 is pretty good. Return on assets, return on equity, we'll check that out, right? So NCB is one of those companies that you do get a lot of details. But I want to go straight to the outlook for them because we've spoken about them before. Saying deposits decreased there. Insurance contracts, total insurance increased. So maybe I'll do this, right? Because I always feel like I need to give NCB more time because I want to do it justice in terms of our review. That's why I'm saying it may take us the next 20 minutes at least to go through all of it. So I'll just go straight to the report. Yes, so this is what I was saying about the dividend. A dividend was declared. This is payable June 9th. So I think they didn't do one for Q1, but they're doing one for Q2. And I think their last dividend was November last year, right? So they announced dividends 4 times last year, but they skipped one for Q1 this year. I'm sure investors weren't happy about that one because, of course, they were expecting that we're in a season of consistent dividends. So to skip a quarter was interesting. And let me see here. Okay, so these, again, very detailed report, but details are good. I hope nobody is intimidated by numbers. But this is good for us to see, right? Because we like when things are broken down. Interest income slightly down. Interest expense is down as well. Net interest income about what, $1 billion different here? Is that $1 billion? Or that's $1 million? 6 zeros. Yeah, $1 billion down. Fee and commission income is flat. Fee and commission expense flat as well. So this net figure here is pretty much the same. I'll skip these for now. Dividend income, 621 million versus 959. That is a significant decrease in dividend income. Credit impairment losses, gain on sale of subsidiaries. So there was a sale, I believe. Was it the Cayman? So is this for NCBDK? 15 billion. Yeah, so I think this is it, right? But it's contribution profit wide to the group. Yeah, I think so. I think that's what you're talking about. Insurance activities. Insurance, I think, is still seeing some impact here. We know that the space was having some challenges coming from last year. Insurance services expenses, though, for them have gone up, I think 30%, this looks like. Net expenses from reinsurance contracts held, that has gone down. So insurance service results has gone down, right? So 2 billion as opposed to 7. Finance expenses and insurance contracts. So net operating income overall would have gone up by 7 billion. So that's good for them. Operating expenses, staff costs year over year have gone down. Depreciation remains the same. Finance costs up by, is that 16 million? Yes. Other operating expenses, operating profit is up. So net profit 17 versus 5. I think I remember I would have went through this last year. So this is good to see, right? This would be significant growth, what, 3x in terms of profitability year over year. So that is good. So this is why, again, for me, I didn't do the calculation for the dividend. But I thought, especially since I missed the dividend in Q1, to do the dollar dividend, right? But again, I'm talking about it in a vacuum here. But I thought that would have been something that investors would respond favorably to. Not going to go through balance sheet in the earnings review. So did I see their outlook? Let me. And of course, NCB does quarterly their investor briefing. They are good. I would check those out. It's usually on their YouTube channel. I'm looking for outlook. They don't have an outlook. I'm not seeing any there. So I mean, the profitability has gone up. So now this is interesting to me, right? Because we're seeing these numbers, but of course these are missing. These are gaps that hoping the JC can get these filled. But yeah, so you'd have seen growth here from last year. So that's certainly good. But then of course, 15 billion from the sale. I'm just, making that connection there, right? Because if it's not the 15 billion if you take out the 15 billion from the sale, that would actually make it now 2 billion, which would be a decrease from last year. Let me go back to it. I just made that connection. So let me go back to it to ensure that I'm getting this right. So the gain on sale being 15 billion here. So if you take out that 15 billion from the 17, that leaves 2 billion, which means year over year, their numbers would have actually been worse, right? So, yeah, so we'll see. We'll see how things go for them. But that is the connection I'm making there. Paper plate. Knicks is a better team this year, not sure. I thought you were saying something bad about the Knicks. Okay, we're good. We're good. Yeah, so if you remove that sale of subsidiary, I was saying for NCB, then the numbers for the quarter would actually be 60% less, 60% down from last year. So that would actually be concerning, right? So apart from that, I have to go line by line to see what would have gone down here. Okay, so the gain on foreign currency there. Insurance revenue down 4 billion, so that could be it. And the cost for insurance went up. So revenues went down, costs went up. I think that's your recipe right there, right? In terms of why the numbers would be lower this year, right? So there you go. Maybe that's what investors are responding to here in terms of the share price, right? Because this report came out, I think, the 9th, so that was a week ago, and they would have had their investor briefing, I believe, last Friday. So month to date, down 15%, week to date, almost 7%. So right, they would have had the investor briefing last week, so it's down 6.3% since the report came out, right? All right, so I actually do have time for one more. Let me see what I had on my list, because maybe there's another company I can look at. I'm trying to remember the companies I had on the thumbnail. That's what I'm trying to remember here to go through. Spur Tree. I wanted to look at Spur Tree because I think it's very interesting what's happening for them. Right, we haven't heard much about them. Yes, I think Spur Tree may make a good one to close out with. I did. I wanted to look at Panjam. But let's do Spur Tree because I can't remember the last time I heard anything from them or about them, which is concerning for me. So, all right. I won't look at Spur Tree. I'll just look at, well, I'll look very briefly because I do want to say some things about the market in general before we close the stream, right? So Spur Tree is, I remember Spur Tree years ago, I think was over $3, right? So to see it 17% up from IPO price is that's unbelievable, right? So I don't know if it's a revenue thing. So that is significant, right? Because the last thing I remember, they would have done the acquisition for, oh my gosh, Canco? Is that what it's called? Trying to remember. So let's see. Did they do any write-ups? All right, so revenues down about 60 million. So top line is down 15%. Cost of sales have gone down. Well, no, I need to check that margin. That's the thing. I think some reports should come with margin, but of course, if I had time to drop it in Excel, I could calculate the margin there. But gross profit is down 15%. Admin expenses have gone down. Finance costs have gone up about, it says here, 26%. They're still within the 5 years, so they're not paying any taxes yet, but I think the 5 year is next year. So yeah, I think the 5 year is next year. And total comprehensive income, 12 million, right? So down from 28 a year ago. And I'd love to see, I probably will spend some time putting the last 3 or 4 years of data in Excel and go through that, because this down 57% from last year is, it is significant, right? But I can't remember the last time we've heard or seen anything from them. I'm not sure what's happening. Not sure what's happening, right? So maybe I can try and reach out for an interview and see. Let's see what the outlook says. The outlook for 2025 remains positive despite temporary headwinds experienced in the first quarter. Now, this is always good, right? Companies being positive, that's very good. I'd just love to see, what that translates to, right? So that's what the chuckle was for, right? Company continues to demonstrate resilience and growth in its core operations. And I will say, right, there's a lot to be said for being profitable, right? Because it is a challenging time overall. So them still being profitable is good, right? They haven't slipped into losses, but that is a significant drop, right? Over 50%. That's kind of what I'm thinking though, Troy, and exactly the thought that came to mind for me, because based on how things have been trending, it may just make sense now to do that. I mean, that would probably, if they buy them out, I don't know if that means that they would be delisted. So we'll see. But I was actually expecting these kind of things to happen in this climate, right? So I wouldn't be surprised if we see some acquisitions. I was actually expecting more companies to do like maybe a buyout, delisting, etc., because it is a challenging time. So as companies make less and less profits, some will start to generate losses. Which is why some of these prices are where they are. A lot of these companies are not producing, and so that's why the price is going. That's why the stock prices are going down. So it's a good and a bad thing depending on how you look at it. Good in the sense that this could be an opportunity to stock up on a company that you like long term. Bad in the sense that if there's not a clear path for recovery, then you may be holding an investment that you don't have any clarity around, right? Which can be a scary proposition for an investor. All right, the company expects continued growth in traditional product segments, supported by a rollout of new products, increased domestic sales through expanded retail penetration, and stronger trade execution. The scaling of its Amazon and e-commerce presence through optimized listing, targeted advertising, and improved fulfillment efficiency, and so on and so forth. I mean, we'll see for them, right? Which we expect to normalize. So it seems to be issue with AccuSupply. I don't know if that, again, I don't think their revenue is broken down. So when revenues aren't broken down, we don't know what causes the challenge, but that's certainly something worth looking at, I think, Tryon. I mean, that would certainly, that announcement would probably do well for their share price. Paper Plate saying they need to strengthen their logistics and lower their prices. If they lower their prices, that's not going to do well for profits. But maybe lower prices would mean more volume. More volume may mean, I mean, to me, it's maybe 6 or 1 half dozen or the other. If they lower prices, they may sell more, but profitability may still be impacted. And I mean, they're in a very competitive space, right? I don't even notice 90% of the things on the shelves in the supermarket. And I was at the supermarket today. It just blends in for me. I mean, my wife does the shopping mostly, so she can probably see. But I remember in the past, branding was strong. You saw where they just seem to have been everywhere, and I'm not necessarily feeling their presence anymore. That's certainly noticeable, right? But Renee says they seem to be focusing on exports. That's okay. Exports presents its own challenges, so we'd have to see how they deal with that. They do say they expect things to normalize this year, but we will see. But to how the stock price has fallen, I would imagine that this has been happening for the last 2 years. So we will see there, right? So I just wanted to go through a couple of reports. A lot more I wanted to go through, but I'm trying not to make the stream too long. So hopefully you got some value from it. I'll ask you all who are here to like the video. Thanks to those who share it. I saw it in a couple of groups. I appreciate it. We are having our community meetup tomorrow. I was looking forward to the interview with Alexander Melville in our challenge community. That has not been, a new date has not been set for it. I do know they are having an investor briefing. Maybe persons can visit that to get feedback as to what's happening, the offer that they have out on the market. I'm assuming they may do things like maybe be on taking stock next week or something like that. But I'm not sure. I haven't been able to finalize things with them. And I was gonna say that I am cautiously optimistic that the year that I thought we were gonna have in terms of activity in the market and certain industries recovering, it's still possible. But Q2 will tell me that, right? Because I'll do like a half-year review and see. But some companies I did not expect to be struggling are struggling, and it could be that the strategy, I think, would be to focus on companies with strong balance sheets now. So this is where we may need to start looking at the balance sheets more to see which companies can weather the storm. Because if they can't weather the storm, they have to borrow or take line of credit or something, which is essentially borrowing. That's going to impact, that's going to grow their finance costs. That's going to impact their bottom line. And that's not going to do well for the stock price. Yeah, man. So I didn't even need to look at Panjam and JP to know they likely did well, right? And Panjam is in, well, they're in a lot of industries. You can watch our interview with Jeffrey to learn all about what they do. But you know, I have no doubt that they're doing well, right? Why Melville never allowed Tropical to list Rose Battery on the main market and pay back some of the loan? Interesting. That's certainly a question for them. List Rose Battery. I mean, thinking about it now, why would you want them to list and separate, right? I mean, I get it as an alternative, but I'm not always a fan of divesting companies in my portfolio that are generic. So if from the Tropical perspective, why would shareholders want you to divest something that's producing so many revenues and profits? That doesn't, I wouldn't want that as a Tropical shareholder, because my prospects of cash flows and dividends coming in, it improves with Rose Battery being a part of the group. Now, finding a way to pay for that acquisition cost is a big issue. They had alternatives, of course, but I mean, I didn't do I haven't done I'm going to go through the calculation and that stuff, because we're gonna be reviewing Tropical in our challenge community tomorrow. But it is a significant number of shares being added. So things like that will impact earnings per share and other things. So it's good to own a smaller piece of a larger asset. It depends. In theory, that sounds okay, but what piece am I getting? Because again, you know, Tropical itself is not like they're doing billions of dollars in revenue. If they split out Rose now, maybe in a few years, if Rose is doing 2 or 3 times what it's doing now, and it's sizable to stand on its own. But remember, from an administrative perspective, management perspective, the company would now have 2 of everything, right? 2 sets of reports, 2 AGMs, two like, companies have to factor in those costs as well. And trust me, Troy, and we work with companies for that. That's a big deal. Those are costs that companies try to minimize, right? I see some companies kind of share those costs, like when they have multiple companies in a group, but it's still a relatively small company, Tropical, right? Because with the Rose Batteries, I think they're doing 2 billion per year now. That's still not a lot compared. So when they're on the main market, 2 billion looks like a big number. When they go to the main market, 2 billion will actually be a small number. So at this time, I wouldn't, I mean, I get your point in terms of good to own a smaller piece of a larger asset. As I said, in some cases, that makes sense. For them, I wouldn't, I mean, I don't know if that would necessarily move the needle for me. I mean, it may be received better by investors because the word APO wouldn't come up, but like, again, I'm not one of those investors that can't see past that word, right? So, but what I think is also an option for them, I mean, depending on how the fundraise goes, because if they can find a way to get cheaper debt somehow, because they do have a US entity now, right? Access to capital in the US, and I'm thinking of that because that's something that we've spoken about with another company before. I won't say the name, but if they could, for example, get cheaper capital in the US to pay down the debt, because the interest rate on the debt they're paying locally is significant, right? I'm sure it's double digits, if I'm not mistaken, or close to it. If they could have paid down the debt that way, instead cut down the finance costs, maybe 25%, 40%, they'll still be able to realize more profits without necessarily issuing so many shares. That's another way that could have been done. I mean, there are other ways to raise capital apart from the APO that they're doing, but splitting, just like I don't think necessarily a splitting of Dollar and Ultra makes sense to me, right? Especially based on just, again, together numbers look great. When you split out the entity, just like if you split out Ultra, you split out Rose Batteries, the numbers look different now because you'll have costs on each side. So together you actually spend less than if those things were split. But of course, different pros and cons for different, scenarios, but that's what I would say to that. So if it's a really big asset, so if it's a really large asset, Tryon, I'm with you on the same page there. But in this case, I mean, it's only been a year, but we'll see, right? But I certainly agree with you if we're talking about, let's say, the numbers they're projected to do within a year, if that was maybe 2 or 3x what it currently is, sure. But I don't think with what we've seen just from last year till now, I would do it based on what we're seeing. But yeah, certainly appreciate that feedback. And for everyone else, I'm looking to say there are some reports. I've gone through a lot more reports than I was able to go through here, because I like to see how the market is trending, what industries are doing well. There are companies on my watch list that I'm going through. I have made some recent purchases, so my portfolio is looking very different than when the year started. For some companies that I'm thinking will have a good rest of year. So I'm certainly interested, and I'm preparing to go back into the US market because I had exited earlier this year. So I'll see how that goes. All right. Have a great weekend, everyone, and we'll see you in the challenge community tomorrow for a stock review for Tropical. All right.
Learning is the key to successful investing, and who doesn't want to invest in some way?
Here at L.E.A.R.N. Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at L.E.A.R.N. Grow Invest.